On the side note, I'm gonna bring up my chart and I'll give you some actual examples. If you wrote a loan at, say, at 8%, and we're looking for a 12, 360 months, we're looking at 71% on $100,000. We buy $100,000 note for $71,000. If you were at an 8% note, $100,000 for 360 months, $71,000, we would make an offer, generally speaking. But if you made that thing at 10, we're up to 85% because of that number. So in the class we'll be working on later December, is that's one of the biggest features. Mm-hmm. Get the interest rate higher, and then just the term, because you can play with that number to get a term that works out.
And within reason, of course. If you're going out 40, 50 years on the term,
but, yeah, I was going to say Dodd-Frank might be a little, might actually come into play on something like that.
Yeah. But that's the number one factor is what's your interest rate. So that's why we're big proponents of like boost it up as much as you can within reason. That payment has to be affordable, otherwise none of it works. But that's a big deal. Make sure that interest rate is nice and high.
I'm just running some numbers in the background to give you an example. If we had a $1,500 a month payment, right, and you sold for $100,000, and if the loan's a 10% interest rate, that's 97 months, right? So it's easy to do. If that thing is now 300,000 and you need a $1,500 a month payment, it doesn't work, right? We get that. Unless you go longer term, whatever, it just doesn't work. So we get all that, but we want to make sure that it makes sense, because if you ever need to sell it, you're going to expect a huge discount if that doesn't happen, right? Down payment to us, 10% is good. We don't really kind of picky on that. The one thing we talk about in the class is seasoning, which is, will we table fund? I mean, buy at the table? We will, but our yield or return is going to be really high because we have no proven track history. Does that make sense to you guys?
Risk.
Yeah, absolutely.
Yes. Yeah, a little more risk on that.
So what's your thoughts on this, feeling about stuff?
How can we work together? How can we do a bunch of deals?
Hey, I know you guys are, you're in the note world. It's actually how we can work together is that, Ken's way more versed in the note buying aspect than I am. But man, if you guys are looking for good notes, we'll have to start looking at interest rates. I do have a question for you though.
Yeah.
So let's say we pick something up subject to. Let's say we pick it up and that note was the terms of that note are less advantageous. Let's say that it was, I don't know, we bought it last year. This is like a this is a totally made up scenario, but that note was written last year and it was at it was at 7%.
Okay.
Right. However, that property's appreciated. The value of that property's gone up. I don't know, let's say it's been 30%, which is not too far fetched.
Sure.
For the past couple of years. So now we've got that underlying at 7%. We go out, we find a buyer, we find that buyer at 11%. As long as that underlying note is, we can pay that off. And it's just imaginary numbers. Let's say that we're looking to sell the remainder of that, or we create two notes. Right. So we create a one for that underlying mortgage that covers that underlying mortgage. And now we have this other one.
Yep.
That is going to, we're going to sell both of those. We're going to sell both of those notes. You're going to pay the underlying off. Now you've got this other note hanging out there. So that for you would be, correct me if I'm wrong, that would be a scenario that would be advantageous to you, because now we've got a note that's sitting at 10% that, and it's not going to matter. It's basically a wash. You have you have the security, you have the property.
Yep.
You have the return that you're looking for. And so on 10%, let's say that you buy that at 85 and everybody gets paid. Everybody gets paid and the underlying gets paid off. Everybody's happy. Right?
So then you're talking about so when you sold it on wrap, you did it as a first and a second?
Yeah.
So
I guess it doesn't really
personally-
matter, but
yeah. And personally, I would buy the first. However, I've got people that would buy the second. I was just talking
Well,
to
you
a
guys
friend
can
last
keep
week.
the second.
Or
You can
keep it.
literally
Or we keep it as our
Yeah.
cash flow, right?
Yep.
Yeah.
Yep.
It's
Yep.
now you're out of the deal completely. All your cash is out and you're clean and you're collecting a second, and typically that second's a little bit higher, right?
And even if you're even if it's $200-300 a month,
I guess my question
Free
is,
money.
what would be your desired spread there? Well, I guess you'd be paying that first off. I mean,
Yeah.
Okay. So yeah, that would make sense.
Changing your hats. We're wearing
Yeah,
different
yeah,
hats
yeah,
here,
yeah.
right?
Yeah.
And we've spent an hour talking about the whole subject to stuff, and now we're moving on to the ideas. How can we help you guys create that note? You know, you already found the borrower, you found the seller, you made all the connections. Now, how can you make that something you can get out of if you need to, or to cash flow and make some money, right? Because you bought it at a much different discount. And yeah, you can create 80-20, 85-15, and we're going to buy 85% to make our yield. And that's what comes into play here is that calculation. So Hans asked the question, what are note buyers paying for CFDs that are not underwritten by RMLO, but are seasoned and have yields of 7 and 9%. So what I understand your question being yield, meaning the interest rate you wrote the CFD at 7 to 8, 9%. Again, you can use a calculator and say, okay, if we say we want on a CFD, which is a little more risky, right? Because it's not a mortgage and note. What if we set it as, say, a 14, you can quickly figure out estimatedly wise, that's a word, what is the estimated purchase price that a note buyer would buy it at. So set the calculator at 14 and say what discount it is. Now, Nathan may buy it at 13.5, I may be at 14, and someone else may say 17. And that's how you can kind of figure out estimated wise what we would expect to buy that note at.
So the factors there are what's the current interest rate? That's going to be the number one factor. Number two is it's a CFD. It's considered a little bit more risky. Number three, you said it didn't use an RMLO. Non-RMLO is not going to sell for as much. It can probably be fixed. I can probably go through and qualify that borrower through an RMLO. However, that's going to cost me time and money, and just, manpower having to get it done. So those are the three factors that are going to be considered when talking about what kind of discount you're going to get. But there it is.
Yeah.
So like you say, like a 14 is probably more realistic than a 12 is what we're looking for at that point.
So yeah, that's one of the features, right? Is RMLO, CFD versus a mortgage versus a note. Those kind of things are coming to play. And for you guys doing wrap notes and with an underlying, I call it third-party borrower. I don't know what the word phrase is. You're really sub to another loan. We don't, as note buyers, want to buy that wrap note unless we pay off the underlying lien because of the messiness and the trust and all that stuff. I haven't ran into any note buyers who are okay with doing that the other way, but we want to pay it off. And I know the math doesn't make sense. Why are you paying off a 3% note? It's just the legality side of things. We've had Jeff Watson on talk about it. It just doesn't work for us.
If and when it defaults, that would get really ugly and just not something we'd want to deal with.
No, keep it clean. Yeah, keep it
Yes.
clean. Totally understand that.
Yeah. And
the
make
idea
sure
is for you to be the bank and not have to pay another bank.
Exactly.
That's
it's
the
not
idea.
even paying the other bank. Is that if you had a deal where you had a hard money loan from Nathan, right? And you're the borrower and you wrap that note and there's no, I call it third party borrower, that I have no problem buying that note now because I know who the borrower with the original note is. It's when that third party person gets pushed aside is when it gets murky, right? You have to do a trust and all the stuff to get around it. We don't prefer that method. We'd rather you sit there and say, hey, I'm the borrower on this deal. I owe, 8% note to my hard money loan. I created a note at 11. I'd like to make sure that I can, I have no problem buying that wrap note because I know you're the underlying borrower and that they won't call the note and we have no trust issues, trust being the entity issues, those kind of things. That makes sense to you guys.
Absolutely. Yep.
Right.
And
Go
to
ahead.
answer, could I just say to answer? I think
Yeah.
Nathan mentioned is like,
Mhm.
how can we help each other's our communities and what we do and what you do and how to put that all together.
Yeah.
So one of the things Jeff and I like to do is we like to offer like turnkey methods and turnkey strategies for our people. So you, right,
Mhm.
are a turnkey disposition strategy,
Mhm.
right, to a large extent. So I think from a offering our community and your communities and what can we do, I'd like to talk, and we could talk more about this, but
Yeah.
talk more about what are you looking for. You already mentioned like you're going to be doing
Yeah, webinar, yeah.
information on what does that note need to look like, or even backing it up, like you're one of the few people that I've seen that are even entertain a contract for deed,
Mm.
right, a land contract, actually
Mhm.
buying that. So what do those need to look like? How can we turnkey that to our community and offer structuring that so that then it's valuable to you on the disposition side, whether you to buy
Win-win.
it potentially, right?
Yeah.
Yep.
That's huge, right?
Fantastic.
Nathan
Yeah.
comes along, you guys have 10 CFDs, you need to buy it at, and I would encourage you guys to create these notes at a higher interest rate to avoid the huge discount, right? If you create a CFD at 9, he comes in and looks at 14, 15, the discount just gets disgusting. So we encourage you guys to do that. You guys are doing such awesome work,
Yeah.
getting a hold of a seller, finding the property, and then creating this borrower at the back end of it, and make sure the structure is legal and everything's great. We're just trying to fine tune the one little part of it that helps you guys dispose of it. So we even get into the fact you can sell partial. So if you had a situation, you can sell, instead of the whole note, you can sell 60 months of payments, right? We're not going to get into hypothecations, but in the partial world, you could sell a year payments, 6 months of payments, 10 years of payments. If you have a low first balance, you could do that and pay off. You say, Dave, I owe 38 grand on a $200,000 house at 3%. Could you give me 38 grand for a certain amount of payments? And I say, great. As long as you pay off the first, I'm cool with it. Yeah, no problem. And I get 60 months of payments at 14. Slam dunk home run. I'm ecstatic. I'm getting my return. You guys are great. You guys are, and after 60 months, you're going to get the cash flow for the next 30 years or whatever long it is. So
And
we
the
want to make sure
partials
that
will be
you guys,
more in Dave's department.
Yes.
I'll look at the CFDs.
Yep.
Dave's gonna look at the partials.
yeah,
We got
yeah.
Well,
Right.
there's a second benefit there. I mean, that you're looking at CFDs, Dave's looking at
Yeah, partials
notes
over
and
there.
partials, then there's yet another opportunity for us to maybe take the dive into more fully underwritten. I won't say fully underwritten. That's the wrong term, but to more qualified
Airtight.
on the qualified side versus
Yes.
non-qualified loans. Yep.
Yeah.
Yeah. Airtight notes and contracts for deeds.
Yep.
Yeah.
Awesome. Very good,
So-
guys.
So we have our before we go into the after hour party with you guys and we disconnect from the live crew.
Drinks are on Ken.
Yeah. We need your brainiacs, your knowledge, your experience. Go ahead, Nathan.
Yeah. So I mean, you guys you've been around now for a little while now. You've seen some stuff. I get the feeling that sub 2 and all the creative finance is growing, and it's becoming more mainstream, for lack of a better term. But we're seeing more of it, that more than we did a couple of years ago, for sure.
Definitely.
What are you seeing coming up on the horizon? Are you looking at more of it coming up your way? Are you seeing a crash coming that's going to contribute to your business or our business, or what do you see coming down the pipe?
Well, I
Let
mean,
Ken go first. Okay, good, Jeff. Good, go first.
Okay, sorry,
6
sorry.
months a year. No, good, Jeff. 6 months a year from now, maybe 2 years. What are you seeing?
Well, I'm a kind of an outlier because I started doing this, a long time ago when it wasn't popular.
Mhm.
And so one of the things I continually tell people is that, because you got all the gurus now, all the gurus are saying, now, you hear them, they're slamming it. You brought somebody up earlier that just recently jumped into this stuff. And I'm like, in my mind, I'm going, okay, I've been doing this entire time.
Yeah.
Mhm.
You're not going to tell me that there isn't a best time to at least understand the stuff and get into it, because
Yes.
as I like to say, any time is a good time to understand creative finance, particularly subject to.
Well
If
said.
you know when to go out, and if you're looking at a mortgage that you're thinking about taking subject to, and you see the trends, that you'll get to this point where you see maybe a loan was originated in 2015, you automatically know that's something you're gonna go after,
Mhm.
because you know that interest rate is going to be stupid low. So I mean, I guess the answer to that question is there is no, as long as the spread is there, as long as I know I can do something on it and make a spread, I don't see this coming to an end, not in my business. And I would recommend that anybody out there looking for on the creative side, never exclude creative financing from their strategies, because it has been a total game changer for me.
Well said. Ken,
Yeah.
what do you see? What do you see the housing market and the whole world of real estate? Are we looking at like a 20% crash coming up, or are we looking for prices to stay flat?
Well, that's a good crystal ball type of question, isn't it? But first, I'd like to agree with Jeff. Like we've been doing creative financing and subject to just being one piece of a creative financing strategy for years now, right? But we didn't just jump on the bandwagon. So and I think Jeff's 100% correct. It's just going to continue. So knowing how to do that and putting the tool in your toolbox, right, which is our whole theme today, is definitely the thing to do. I do watch trends and things, especially here in our market, the St. Louis area, Missouri and Illinois specifically. And I mean, who the hell knows? I can't quite figure out, because just when I think I have one thing figured out, then something else changes. I do know this though. Common sense says that the pressures in the market, that the housing market, the high interest rates, all that, it can't continue without a correction.
Agreed.
Right. So, I think like we need to really start preparing ourselves for what that means and how is that going to impact our business. Not that we have to rewrite and go back to the drawing board with what our business is or our particular real estate niche, but how can we adapt, right? And be flexible moving forward. And what do we need to do, right? So if we continue this high interest rate environment, obviously the seller financing stuff that we're talking about here today primarily is going to continue, right?
Sure.
And the opportunities there are going to continue to abound. We also have this mindset issue, I think, though, with the whatever we call them, the generation coming up, right? Those people that are at college age, I say that, right? I just turned 50, but those people that are college age that are coming up, right? Just kind of have this mindset. Well, I'll stay at home until whatever's right. I'll live in the basement, or like I don't know where that mindset came from, but we have to be able to adapt, because there's a large number of people that are going to be talking about, am I getting married? Am I going to have kids? Am I going to move out? Am I going to rent? Am I going to buy? All those sorts of things. We need to be prepared to adjust and be able to help those people, right? We're here to help people. We solve problems. Jeff and I solve problems.
Yeah.
Like we're pretty good at solving problems, right? Hence the whole creative finance strategy. So we just need to figure out what are those problems to solve for people and how can that potentially benefit them and benefit us.
Awesome. Inside the comment box, there is a bit.ly link. If you want to get a hold of Ken or Jeff, use the bit.ly link and you'll get all the information emailed. And then we'll go from there. Guys, it's been a pleasure hanging out for after hours, but I want to thank you guys for tuning in with us and spending the afternoon or the midday with us and sharing your experience, your knowledge, your years of just brain power to share with you guys. The time, energy is greatly appreciated, and the fact that you guys are willing to be open and honest and not closed-minded and not sharing details is very appreciated. We're really thankful for you joining us today.
Yeah, it's been good. Thank you.
Feeling is very mutual. We appreciate you guys.
Thanks so much for having us. Yes, absolutely.
Yes. Well, guys, hang on for after hours. Everyone who's listening, we will see you soon. Our next webinar is December 15th. We're going to be having Dave Polio. If you don't know who he is, you'd want to.
You should. Yeah.
Yeah. Here we talk about the market, the status of the market of the note space. So enjoy your weekend, everyone. Have a great time. Take care, everyone.
Thank you.